The U.S. economy has faced a perfect storm of challenges in recent years: high interest rates, persistent inflation, and ongoing global tensions. Despite these headwinds, the American economic engine is still running strong, surprising many experts who predicted a slowdown or even a recession. What's behind this unexpected resilience? The not-so-secret reason: artificial intelligence. AI has rapidly become the driving force behind much of the country's economic momentum, quietly transforming industries from finance to manufacturing and even retail. Once the stuff of science fiction, AI has shifted from a futuristic subplot to the main engine of American growth. It's no longer just a buzzword, it's a real, tangible factor shaping the way businesses operate and compete. Today, AI is the backbone of the economy, driving both massive investment and unprecedented productivity gains. While traditional sectors like manufacturing and retail struggle to keep pace, AI is setting the tempo for economic progress. In fact, AI-related capital spending alone has added a full percentage point to GDP growth, a huge deal in economic terms. This surge is fueling optimism on Wall Street and Main Street alike. The stock market, corporate investment, and even everyday consumer spending now seem to orbit around AI. From tech giants to small startups, everyone is betting big on artificial intelligence to deliver the next wave of prosperity. The U.S. economy is no longer a balanced mix of industries, it's become a high-stakes bet on one transformative technology. As tech offices buzz with activity, other sectors are being reshaped or left behind. This growing dependence means that AI's success, or failure, will shape everyone's future, from Wall Street's financial titans to Main Street's small business owners and everyday workers. In many ways, we've hitched our entire economic wagon to AI, for better or worse. The stakes have never been higher, and the outcome will touch every corner of American life. The question now is, will this bold bet on artificial intelligence lead us to a new era of prosperity, or are we racing toward risks we can't yet see? Only time will tell if AI is the golden ticket or a gamble with consequences. If you want to understand just how deeply committed we are to artificial intelligence, all you have to do is follow the money. The scale of investment is staggering, and it's reshaping the entire landscape of the global economy. Every dollar spent is a signal of belief in a future powered by AI, and the numbers keep climbing. Tech giants like Google, Microsoft, Meta, and Amazon are pouring trillions of dollars into building vast data centers, designing ever more powerful chips, and securing the energy needed to run these digital empires. This is fueling the largest investment cycle the world has seen since World War II, with each company racing to outspend the others in a bid to dominate the AI era. At the heart of this frenzy is NVIDIA, the undisputed king of AI chips. Not only is NVIDIA selling billions of dollars worth of hardware to these tech giants, but it's also reinvesting those profits right back into the same companies that are its biggest customers. This creates a self-sustaining feedback loop where each new breakthrough drives even more spending and innovation. This unprecedented spending spree has become the main engine of U.S. corporate investment. It's driven by a mix of FOMO, fear of missing out, and the tantalizing hope of massive future returns. Boardrooms and investors are betting big, convinced that AI will unlock new markets and transform entire industries. But there's a risk. If those expected returns don't materialize, the entire system could seize up. Companies that overextended themselves might be forced to cut back, and the ripple effects could be felt across the economy. We've built an economic engine that demands constant, ever-increasing fuel to keep running. If confidence in that growth ever falters, the machine we've built could slow down, or even stop, much faster than anyone expects. The AI boom isn't just a boardroom story, it's boosting Americans' wallets through the stock market. In 2024 and 2025, a handful of AI-heavy stocks drove nearly all S&P 500 gains, creating a wealth effect. As portfolios swell, people spend more, fueling a feedback loop. Stock gains boost spending, which boosts profits, which boosts stocks. But this optimism masks deeper economic weaknesses. If the market turns, the wealth effect could reverse fast, shrinking retirement accounts, slashing spending, and sending the economy into a downward spiral. Our economic house is built on market optimism, and that foundation is looking shaky. Some compare the current AI boom to the infamous dot-com bubble of the late 1990s, when wild speculation and sky-high expectations led to a spectacular market crash. But there's a crucial difference this time around. Today, AI isn't just another tech trend, it's become the linchpin of the entire US economy, woven into everything from finance and healthcare to transportation and retail. If confidence in AI falters, the consequences could ripple far beyond Silicon Valley. It's not just tech stocks at risk, it's the whole financial system, and the livelihoods of millions. Imagine a scenario where a 30% market drop wipes out $15 trillion in household wealth almost overnight, leaving families scrambling to adjust their budgets and rethink their futures. Consumer spending would plummet by hundreds of billions of dollars, as people cut back on everything from groceries to vacations, sending shockwaves through the broader economy. The result? A deep recession, with businesses shuttering, unemployment soaring, and communities struggling to recover. The real danger isn't that AI technology will suddenly stop working, but that a sudden crisis of confidence could unravel the entire system. If investors begin to doubt AI's promise, panic could spread quickly, leading to a rapid sell-off and a downward spiral. The fear of missing out would be replaced by the fear of losing everything, as investors rush to pull their money out. In such a scenario, the sell-off could be brutal, with markets in freefall and little hope of a quick recovery. Figures like Michael Burry warn that many companies are inflating their AI profits through creative accounting, masking the true risks beneath the surface. When the truth comes out, big write-downs could follow, erasing years of supposed gains and shaking investor faith even further. If those profits vanish, so does the optimism that's been propping up the market, leaving investors and companies exposed. We've created a single point of failure, AI confidence, at the very heart of our economic system. If AI stumbles, there's nothing left to cushion the fall, and the consequences could be more severe than anything we've seen before. The job market looks stable, but beneath the surface, AI is quietly reshaping it. Companies aren't laying off en masse, but they've slowed hiring and wage growth. Young workers and new grads face a tough market as firms use AI to boost productivity instead of expanding staff. Data center construction creates temporary jobs, but once built, these facilities need few workers. The result: rising profits and productivity, but little benefit for most workers. A small group of AI specialists and executives reap the rewards, while everyone else faces stagnation and the threat of automation. The gains are concentrated, not shared, deepening inequality and fragility in the labor market. The AI boom is fueling a K-shaped recovery, where the rich get richer and everyone else falls behind. Owners of tech stocks and top executives are seeing unprecedented wealth, while renters, young job seekers, and those without equity are left out. The economic gap is turning into a chasm, with prosperity concentrated at the top. This isn't just unfair, it's risky. An economy reliant on the spending of a wealthy minority is unstable, and there's a limit to how much the rich can buy. Broad-based prosperity is essential for resilience, but AI is making the economy more brittle. The divide between AI's winners and losers is stretching society to its breaking point. In the past, the Federal Reserve could cut rates to rescue the economy during downturns, providing a reliable safety net. But now, with inflation still running high and long-term rates remaining stubbornly elevated, its options are more limited than ever before. The Fed can't cut aggressively without risking a surge in inflation, and modest cuts aren't enough to truly stimulate growth or confidence. The only hope is a massive productivity boom from AI and new technologies, but that's still just a theory, not yet reality. The US economy has become a one-engine system, powered almost entirely by AI innovation and digital transformation. If that engine keeps running strong, we could see a new era of prosperity and growth for everyone. But if it falters or stalls, there's no backup, no plan B waiting in the wings to save us.